Well, hey there, everybody. Harris's new tax proposal for 25% tax on unrealized capital gains. That has been getting a lot of traction on social media here recently. And I just want to set the stage here and actually let people know of what this actually does mean, what it's actually taxing, who it's actually going to affect. And it might affect more people than you actually realize once you start realizing the unintended consequences of a tax like this. So here we go. There's going to be a couple different sources we're going to be using here. I've got Forbes as a site. I've got PolitiFact coming in. I believe I've even got taxfoundation.org that's going to be in here. So we've got quite a few. And I want to so here's like who it's going to affect, who it's not going to affect, at least, at the outset. But then we're going to talk about how it can affect a lot of other people. So Harris's new wealth tax proposal would work like this. Households with more than $100 million would pay an annual minimum tax of 25% of their combined income and unrealized capital gains. And it's like if you purchased a stock for $10 and it doubles to 20 in the first year, but you still hold it, even though you haven't sold it, that $10 gain would now be subject to this new tax. That's how it works if you're over that 100 million. Real estate would work the same way. You buy a house, a building, or some land. The increase in value over time would be taxed every single year, even though you still hold it and have never sold it. We have never had a tax on gains that are not realized, meaning they're not sold. So in that sense, this tax would be absolutely groundbreaking and in a bad way. And it's similar to something that Biden actually tried proposing, I believe, like in 2021 or so, which I was like, there's no way that this is going to go through. It was similar to this, but there's a few other nuances that this has that did not have. But in the same way, I was like, there's no way this is going to go past. I believe in my heart, I believe that this is just another let's tax the rich type of a statement. And there's nothing behind it. It's never going to go through. Apart from the policy, there are administrative issues galore with this issue. How do you go about valuing everything every year to be taxed? Public company stock is pretty straightforward, but most assets could be an absolute nightmare. And who in the end gets to carry the day on the value? Disputes about values in tax cases are legendary and very numerous. So nearly every single estate case with the IRS includes valuation disputes, often with competing experts even. And in some income tax cases, charitable contributions of non-cash assets like real estate or crypto also often end up in major valuation fights. So just imagine what the annual value statements with tax returns might look like in a world where the increase in value since last year's turns into taxes every year. Capital gains have always been singled out for lower taxes, not higher taxes. And except in the case of estate tax measured in death, it has been nearly sacred not to tax earnings that you did not receive. And so besides, what if the value spikes one year, you pay tax on it, and then it plummets the next year? You still have the now, well, worthless asset. It may not be worthless, but you can't sell it for as much. Why the unheard of shift to tax something before its time? And what's arguably the scariest part of the idea is what if this opens the door to a more generalized effort by the government to tax us on something that we still own?